Hey, welcome back. This is Mr. Market. We are now into episode 9. Thank you so much for joining me. We're going to have a lot of charts today. The market is undergoing a period of transition, and I want to show you why. So for the past week, the stock market actually fell. As for our portfolio, we actually had a pretty good week. Again, our strategy of selling these put options is working quite well. As long as the market doesn't fall below our level, we tend to do just fine. So for the week, we were up $2,091, putting our year-to-date return to up $13,261. So we are about 26% of our way to our annual goal, and we're 49 days into the year, so that's 13%. So we're running at about 2 times the pace of our annual target, which is great. But then again, the market's been on easy mode. So, I kind of don't expect that to last, but I'm going to enjoy it for as long as it does. So for this past week, we had puts at $395. And as the market rose, I had more at 400 and then even as high as 405, where the market had some more support. But the market fell after the PPI report, and it got right to my 405 level, and it dipped to 404, and I had rolled down to 404, and the market bounced right back up again. So again, if I didn't do anything, I would have made more money. But we have to be disciplined. This is one of those situations, one of the many situations that we'll have in the future, where you have to experience the pain of discipline in order to avoid the pain of regret. And so I didn't make money off my 405s since I gave up those profits trying to reduce my risk to 404. Trying for extra credit never hurt, but still overall for the week, it was still very positive. And in light of a down market, I'm still pretty happy. So for this past week, we started out very cautiously, and we had CPI and PPI coming in. And as the CPI numbers came out, people really didn't care so much about the numbers coming in a little bit hotter than expected. And I thought that was a little bit of a bullish sign. But then a couple days later, we had PPI, and that came in hot, really hot. And that started to get a lot of market participants worried. They're all wringing their hands like, oh no, maybe inflation is actually going to be around. It's going to stick around longer. This disinflation narrative might end up being transitory after all. And we had a couple Fed governors say, all right, hey, we probably should be raising interest rates more aggressively. We had a couple of them say 50 basis points, 0.5% at the next Fed meeting to slow down inflation even further. If you look at the data, actually, inflation takes a long time for it to go down. Once it hits this 8% level, history shows that it takes like 3 to 4 years for it to just kind of hang around at 6%. It doesn't go straight back down to 2%. If the Fed is going to do something to bring it down to 2%, they're going to have to take some more drastic measures and raise interest rates significantly higher than where they are. And the problem with that is that we're seeing slowdowns in the economy. The manufacturing numbers are starting to go negative. Interest rates have gone up to the point that the housing market has slowed down significantly. And if the Fed raises it even more, it could tip this fine balance and put us into a recession, which is what the bond market is predicting all along. For this week, you'll start noticing that the upward trend in the market has broken. So for, up until this past week, the market has been on easy mode. Just buy your stocks and they all go up and everybody's happy and makes a ton of money. But now that the trend is starting to break down, we're going out of easy mode and we're now going into medium mode. And so the pendulum algorithm is getting a little bit more bearish. And so I'm starting to be even more cautious than before. A really important set of indicators that I look at is the volatility index, the VIX index. And that has been in a persistent downtrend since October. And that downtrend has recently broken. And whenever that VIX starts to trend upwards, that's when problems tend to happen. So I try to be cautious in this environment. We have more Fed hikes coming on the way, and when that happens, you have something called less liquidity. There's less money flowing around in the economy to keep the economy going. And so tighter liquidity, less liquidity, typically translates into poor returns for the stock market. And there's a couple of charts that shows that. Here's one of them. When you look at the overall market, though, yes, the short-term uptrend has broken down. It's now below the 21-day moving average, which becomes more and more significant. But overall, the market's long-term uptrend is still positive. The market's still above the 50-day average, still above the 200-day average. We still have this golden cross configuration. So I think where I want to go place my bets is right where those levels are. So my short-term target would be at those support levels for the 50-day and 200-day average, which would be about 395. The 50-day average is about 396. The 200-day average is at 393. So somewhere in between there, I think there would be a lot more support if the market fell down to that level. So another thing to look at is the relationship between stock prices and the bond market yields. We've seen as bond yields have risen, it has usually caused the stock market to go fall because the valuations will fall when yields are higher. Now, when the yields actually fell, the stock market rose. And so that's the relationship that we've been seeing for the past year. But there has been a divergence since the beginning of the year. We've seen the bond yields start to move back up, but stocks were also moving up. And this divergence is kind of like an air pocket where I think it creates a little bit more risk to the downside. And if we looked at where bond yields are right now and where stock prices were back then at current bond yields, that suggests a downside target of about $383 for SPY. So all of that is kind of converging to where those support levels are for the 200-day average, the 50-day average, and that would be my short-term downside target in a negative case scenario. Is it going to go down there? I don't know, but the trend is starting to deteriorate and it's pointing in that direction. So the name of the game for this coming week is caution. And the nice thing is we have Monday off. And when you have Monday off, that gives us one more day for our options to get closer to expiration. So it's basically, we're getting paid time off, which is great. So I hope you have a nice long holiday weekend. And if you found this to be helpful, please click like and subscribe. And thank you so much for joining me. And I will see you next week.